This is Michael Fox, and this is the Prospector News Podcast. We're a day after the Fed, and joining me is Chris Temple of the National Investor. Welcome aboard, Chris.
Hey, Mike, how are you?
I'm doing good, except that it seems that Jerome Powell turned Grinch on us and tossed another turd in the punch bowl.
Yeah, he did. I was having ongoing friendly arguments with a couple of colleagues in recent days. One is a mutual friend of ours that I do a regular thing with. He was thinking the Fed would still raise 75 basis points. I said, no, they've already told everybody they're doing 50 and nothing's going to change that. But what I don't think the markets were prepared for is that, it was a very hawkish statement. Shouldn't have been a surprise to anybody. The Fed did not change anything that it said in the recent past. And as everybody saw afterwards, they actually raised considerably the level at which they think that interest rates might finally peak come late winter or early spring at well above 5%. So, look, not for the first time recently, the markets got a lot of hopium. They got out over their skis thinking that just because we got a slightly cooler inflation number that the Fed's going to turn tail and run. And they've made very clear, for better or worse, they have no intention of doing that. So, as we're recording this, in the morning on Thursday, the Dow was already down 700 points. Everything that rallied recently has given it back. And the only thing that hasn't reversed some of the sillier moves of late that I think still will is that there's been a huge rally in the bond market with interest rates falling. That is going to reverse itself as we go into next year. And likewise, don't be shocked if by sometime January, we're right back near those old highs on a dollar index, about 8 or 9 points higher than where we are right now. And that's not going to do equities or metals a hell of a lot of good in the short term.
No, I agree. And I'll have to admit to being, you were right at the 50 points. I was one of the ones that figured it was 75, but I was basing that on the more robust than expected job numbers. I figured that would give the hawks on the Fed reason to push for another 75, but 50 seems to have done the damage. But I know exactly what you're saying. It's like the addict who, hears that there's a new drug supply coming and then throws a fit afterwards when it doesn't show up. It's, there was nothing to indicate that the Fed was going to stop raising rates.
No, there wasn't at all. And why some people were getting that in their head. I mean, some folks out there, and maybe you saw this, Mike, on Tuesday morning when the CPI number came out and the month over month numbers were down quite a bit more than expected. The year over year numbers were down less. I mean, the expectation had been for 6.1 on core inflation. It ended up at 6 even. Instead of 7.3 headline year over year CPI, it was 7.1. And everybody went nuts. I mean, the pre-market, the Dow was up 900 points in a blink of an eye. And of course, there was some finger pointing because the rally actually started about 3 minutes before the number was officially released. And, on top of the rally the previous day, somebody had the inside information on what was coming. But that just goes to show you how much, even after this last year, and all the Fed rate hikes, and we're in a new, at least a cyclical bear market, there's still a lot of muscle memory from investors that are, real or imagined. They're looking for every reason to think, oh, goody, the Fed's not going to throw any more turds in the punch bowl, and they're going to be our friend again, and we can go out and throw our money back into cryptocurrencies and the old FANG stocks and everything else, and the Fed's going to have our back. And that, is as horrid a job as Jerome Powell has done to get us into this mess in the first place, where he was an arsonist and now he's a fireman. The one thing you can't dispute in 2023 is this guy has not changed his tune a whole heck of a lot. He's made abundantly clear, and he did again yesterday, that interest rates are still going higher. When they get to where they want to stop, they're going to stay there for quite a while. And even into 2024, they're predicting right now a 4% plus federal funds rate by year end 2024. Forget about 5% plus next year. So, you know, are they going to be able to stay there? Who knows? The odds are probably not. But that's where their mindset is right now. And you know, once again, as we're seeing in the market since the Fed meeting yesterday afternoon, people are having to recalibrate and say, "Oh, gee, maybe this guy really is serious."
The other thing that's being overlooked in all of this is when the rate hikes began, everyone thought the magical number was 4.5. You can't go past 4.5 before the wheels fall off the cart and everything starts to break.
Well, you know,
Well,
if you
we're we're
remember,
we're, we're there.
yeah,
Is things about to fall apart?
one of the surprises of this year, I think, for some people, is that you had four successive 75 basis point hikes. You've got another 50 on top of that yesterday. There's another 75 to 100 basis points probably coming between now and March. And if you'd have told people last Christmas that the Fed was going to do that in 2023 and the way in which it's done it, you could be forgiven, because I would have said this, and I probably did, that the Fed's going to break something before they get to that point. There's no way they're going to be able to raise rates that much without doing some major damage. But guess what? Here we are. So, you know, they obviously had so much liquidity stoked into the system ahead of that they've been able to do all of this, and we're all still here. There hasn't been the equivalent of a nuclear strike on Wall Street or global markets quite yet. There's lots of cracks showing, no question about that. But you know, if you remember when you were with us up in the Chicagoland area back this spring, we had an interesting debate over whether we were going to peak at 3%, 4%, 5%, or whatever on long-term interest rates. And you remember that Connie Harrison and I both said that we could be 4 to 5% on long-term interest rates pretty easily.
Yeah, no, I remember that, and I kept thinking to myself, going, the magic number everyone seems to agree on is 4.5. How can we get there?
Yeah. So I mean, recently, and I said this at the outset, Mike, I think that we are going to see, unless something does break still in global markets somehow, I believe we are going to see interest rates and the dollar both in the coming, and it's only going to be in the next couple of months or so. They're both going to go back toward where their highs were when the markets were most wringing their hands over the Fed. So that means, the dollar index at one point was up around 115. We were 103 and some change before the Fed meeting. We're going to make up most of that ground, I believe, between where we are now and what those old highs were in the dollar, because there's still too large a policy differential between the U.S. and other major currencies, mostly the euro in this context. And likewise, I think interest rates as well. We were at 440 or something like that on the 10-year, all the way down to 340 recently. We're going to go back and make up most of that room as well. So, people out there who like to do some short-term trading probably, wouldn't be a bad idea to think about going long the dollar and short the treasury market in the most leveraged way you can think of, if you've got some cojones and want to do that for the next number of weeks.
Oh, that'll be a fun ride. You'd have to hold on pretty tight for that one.
Yeah. Well, you need to be nimble, because who knows? I mean, there's still, and we've got to ask ourselves that same question that we would have a year ago, looking at what the Fed has now done. Are we still going to see a lot of bad stuff catch up with the economy and markets both? Is kind of in a lagging effect, which everybody knows is there somehow, with all the stuff, all the rate hikes the Fed has pulled off to this point. So we'll see. I mean, because if we do see something like that happen, I mean, look, Europe is a basket case still. Their banking system is an absolute mess. Here we're talking about the federal funds rate at 4.5% top end after yesterday, the ECB just raised it to 2, and they're probably about done over there. The Bank of England can't do much more. China all year long has been easing monetary policy. So, there's only so much more room for some of these other countries and markets that are considerably weaker than the US. And I think that could still might be one of the stories of 2023, is that maybe the US has an on again, off again recession. It's going to be very uneven. Inflation is going to bubble back up in some areas. We've seen all of the relief we're going to get from energy prices. They're going to start going back in the other direction again for a host of reasons. Apparel prices, if you want to buy some new shirts and pants and whatnot at Walmart or Target, you're okay, because they were choking on excess inventories for a while. So apparel prices and some things like that are not going to go up. There's a little bit of relief now where automobile prices, new and used, both are concerned, but we still have got a lot of things that have changed that is going to keep inflation chronically high for some time. And the Fed, I think, knows this. It doesn't want to admit it, which is why one of the more interesting things that came out of the meeting this week that hasn't been commented on that much is that at the same time that the Fed is keeping its longer run over the next couple or 3 years view of interest rates, they're going to be higher for quite a while longer than a lot of people had thought. I think they said 2025 before they think inflation is going to be down near their 2% level. They weren't saying that 6 months ago. And I still think they're whistling past the graveyard where that's concerned. We'll be damn lucky if we see inflation get down to the 4 or 5% range and stay there.
Yeah, I wouldn't disagree with that. Yeah, 6 months ago, weren't they still saying inflation was going to be transitory?
Well, they weren't quite that bad. But they were very smug in thinking that it's going to flutter back down to 2% way sooner than what they're now saying. And so at least, even if they're still going to be wrong with the prediction in the end, at least they're getting the direction and the overall landscape a little bit more accurate, and they're a little bit more truthful maybe than what they've been letting on. So we'll see.
Yeah, well, I'm still of the opinion that they're going to change their target inflation rate at some point, and that'll be about the time that they're going to take the pause.
Well, that'll be interesting. That's a debate that I think is going to come back as we get into 2023 and inflation does prove way stickier. Powell insisted yesterday in the answer to that very question that no way are they going to change their target. They're still staying with 2%. They'll probably, you'll hear more in the months ahead about how, well, we're not in a really cold sweat over inflation staying up, because don't forget that for so long we were at 0.8 and 1.2 and that kind of thing, that we can be above 2% for a while, and over the long run it's going to average out. That's nonsense, but it sounds good. So we'll hear some more of that, but I think they're really loath, for a lot of reasons, to change their target, because it is dyslexic as the Fed is in the way it does policy to begin with. And it's an institutional thing. It's the nature of a fractional reserve system. This is what you get, which is why we shouldn't have either a fractional reserve system or private central banks, either one. But that's a story for another day. But within the context in which they operate and have all of us hostage, they really are terrified of this idea that Powell has voiced a number of times, that they don't want long-term inflation expectations to become entrenched. Because when that happens, it's going to be even harder for them to put that toothpaste back in the tube, because now you start changing all kinds of behaviors. If you're a consumer, if you're a business owner, whatever, they don't want people to get this idea that this kind of inflation like we've had in the last year or so is going to stay entrenched, because then they're really up, the wrong kind of a creek.
Yeah, that's where cost inflation would really kick in because right now wages are lagging behind the inflation rate, and if the belief becomes that it's entrenched, you're going to start to see a lot of labor strife as the labor movement and everybody pushes to get back against that to try and get their cost of living back up.
Well, yeah, and and here again, and that's a good point that you bring up, is that the reason why the Fed has been considerably more hawkish in 2023, and I said this back a year or so ago, I didn't think we were going to get quite this magnitude of rate hikes, and I'm surprised that we have, and I'm surprised it hasn't done far more damage, at least not yet. But one thing I did say from the get-go is that the Fed really is serious to the extent that they can do it without breaking something of getting inflation reined back in, because their political imperative now is much more, at least it has been, much more about Joe Sixpack and Sally Soccer Mom and how much this is hurting the Democrat Party and the president who reappointed this numbskull, number one. And number two, how much it is hurting the Fed institutionally to, in fairly short order, bring us right back to the kind of inflation we had in the 70s and early 80s. And that's, and we all know that they figure these things differently than they did back then. If they figured them as they did back then, inflation is 15% right now, not 6 or 7 or 8 or 9. So now it's going to be interesting to see if Powell starts sweating in the other direction, and he really wants to start using even more of a sledgehammer and not a kitchen knife to try and fix inflation. Because the most disturbing thing, and I think this is going to be a political issue now into this next year, is will the cure once again be worse than the disease? Because what should get a more robust debate going, and I think will, if the Fed continues on this course, continues saying this, is this idea that in order for the Fed to bring inflation back down to its target, there needs to be considerable move higher in the unemployment rate, which means a few million people have to suck it up and take it for the team and lose their job. And otherwise, there needs to be demand destruction. Okay. And here again, this is one of the worst consequences of having a fractional reserve system in the first place, is you get this Hobson's choice, where in order for the Fed to undo the inflation that it was the chief reason for to begin with, they now need to bring about a recession. And that's pretty much what they're going to do when they're done. Well, why does it have to be that way? Why can't policymakers, and we've talked about this before, why can't policymakers change what they need to change, so that instead of having 1.25 million barrels of oil production less now than what we did before the pandemic, we have more, and bring prices down further, or hopefully keep them down? Because there's a lot of reasons why oil is going to go back up in 2023 after having recently surrendered all of its gains for this year. There's a lot of other things that can be done, regulation wise, legislation wise, and whatnot, so that we fix the supply end of things. So that's where the Fed, I think, is going to change somewhat this mantra that they had in 2022, where we're doing this for the little guy. And of course, again, in his hypocritical way, Powell yesterday, when he started his press conference, reminds us about, we feel your pain. We know that this inflation hurts the average household. Well, duh, why'd you cause it in the first place then? But this year, they're going to be a lot more draconian, I think, about how they look at the consumer compared to what they have been. And I really hope that this gives rise to a discussion about the very system that we're all hostage to. And this goes way beyond, a Ron Paul and some others saying, well, we need a gold standard or something like that. That's not the cure for this. We need a complete top to bottom overhaul of our system, including changing the very institution of the Fed itself.
Yeah, when I hear him say that he feels your pain, it reminds me of my father when I was about to get a licking, saying, "This is going to hurt me more than it's going to hurt you."
That's about it. But it's going to hurt millions of people who, if Powell, continues down this road, millions of people are going to lose their jobs. The stock market is not remotely through falling. And real estate has only started to roll over. I know that there are still some areas where things have stayed hot despite mortgage rates having gone up and so forth. But I think that this next year ahead, people are going to feel a lot more where real estate is concerned too, because there's still a lot to go. I'll give you a quick example, and I'm just going to use some average numbers, but I keep my eye on our local North Florida real estate market, especially inland, because inland, there's a lot of nice rural areas, a lot of it on or near water, more so than we wanted recently with the last two hurricanes. We didn't want to be that close to water. But that said, I mean, a lot of places that, right now you could get a real, 3 bedrooms, really nice newer home, on a canal leading into the St. Johns River. The beginning of this year, instead of $250, a place like that was selling for $300. But 2 years ago, it was selling for $125. So there's still a lot of air that needs to come out, even of what in that context I just described seems a quote cheap real estate market. Because when you look, especially during the pandemic and how real estate just went parabolic in some areas, it wasn't uncommon in a lot of parts of the country, especially if they're more desirable, where people, that now that they're working from home, they're able to go and live where they want. You had tripling of real estate prices in some areas, doubling to tripling in 2.5 years, give or take a little bit. And a lot of that still got to come off. And that's going to be a part, along with a continuation or a resumption, however you want to put it, of the broader bear market in stocks. This is going to be part of Powell's game plan of reducing demand. If your stock portfolio goes down another 20%, you're going to spend less money. That's going to take the heat off inflation. If the price of your house or the market value of your house goes down another 20%, you're not going to refinance. You're not going to have the equity left in there that you do now to be able to tap it and go out and buy something. So this is all part of this. And we didn't see as much of either of these this year, especially real estate, as we probably should have, but that's coming in 2023.
Yeah, I don't disagree. I don't know if it's 2023. I'm more inclined to think 2024, because there has to be a point where the mortgage renewals kick in and people can't afford the new mortgage with the new mortgage rate. And that's when you're going to have real estate that goes on the market that has to be sold. It's almost like a margin call in a lot of ways. Because I know here, during COVID, the real estate prices did, like, I'm in Charlottetown in Prince Edward Island off the east coast of Canada, and we were getting like Vancouver and Toronto real estate increases. They've jumped 15-20% in a year, and normally this is like a sleepy medium-sized Canadian city where real estate kind of just chugs along. It doesn't go up dramatically, it doesn't go down dramatically. And I've noticed in the last year in my neighborhood where places got put up for sale, when they wouldn't get their asking price, the people just shrugged their shoulders and went, okay, well, no big deal, and they just took it off the market. Until you get those people who can't renew their mortgage and have to sell the house, I don't know that that's going to move the real estate market that much. And because of that, I think it might be a 2024 problem rather than a 2023.
Well, in that context, you're right. I think that there's still, though, even where I live, where a lot of transactions have been done with cash, and people are making a market call or a timing call, and mortgages aren't part of the equation, I think that they're going to start sweating though a little bit more this coming year. I think it's going to be multifaceted. I will say this, that in the areas I look at around here, for every one listing I saw at the beginning of this year, I now see 3 or maybe even 4. You know, those people out there who like to follow Zillow, you know, if you click on the right page, you know, you're in a little geographical area or town, and all the little red things come up on the screen. It's full of them. I mean, if you know, obviously the picture is condensed, so it's not this many houses for sale, but some of these maps I look at right now, you would think that every house on a street is for sale. So it's a lot. And you know, that's gonna depress prices, because no matter what it's from, I think that, kind of like with some of this other behavior we started talking about at the top of the show, Mike, you've got a lot of people who are still somewhat in denial. They blinked their eyes, and mortgage rates went from under 3%. We were over 7 on a 30-year mortgage recently, has fluttered back down nearer to 6 lately, but I think that's also going to go back up as we get into 2023. And whether it's, you know, involving a mortgage or not, I think a lot of people, just like with the stock market, the comment I made earlier, they had this idea, though, any minute we're all going to wake up from this and the Fed's going to be back to lowering rates and being easy and, you know, making everything happy and wonderful and peaches and cream again. And I think the reality is going to set in more and more that, okay, we just blew off a whole year where we probably should have sold our place at the beginning of 2022 and didn't. Guess what? Now this is going to get worse before it gets better. And so you may start to see some panic buying. You may see, I'm starting to see across the board here in some of the stuff I follow. And again, the prices are still too high after this, but you know, 5, 10, 20,000, I would say 2/3 of the places that I follow, that I have my eye on, there have been price cuts in the last 60 days.
Interesting. As I say, I don't disagree with what you're saying about the supply. Like, the supply here is way bigger than it was 2 years ago. But that's been my observation, is that a lot of the places that I guess don't need to be sold, if they aren't getting what they think they're worth based on out-of-date figures, they've just taken them off the market. So
yeah, some will do that, no question.
it's a question of, do they get to the point where they have to sell, or is it just wishful thinking that we'd like to sell? You know, it becomes one of those questions. But as far as pricing goes, the people are holding the line on the pricing so far. But what it's done is it's extended the length of time on the market for those places that get sold. Prices might have gone down a little bit here, but not to the extent you would think they should, with the interest rates having jumped as much as they have. So it'll be interesting to see how it all plays out. But I think it may be a a longer window before.
We'll see. It'll be interesting. I guess the one good thing, so it's not all negative on this, is that unlike the real estate bust back in 2007 and 8, this has not been nearly caused as much by questionable mortgages, and you're not going to see wholesale defaults and repossessions and foreclosures and things like that. This is more, you know, comparing real estate this time around, relatively speaking, I think is more like looking at what, you know, a Tesla or a Facebook or a Google was a year ago and saying, okay, it should be selling for 40% less than that. Doesn't mean that the world ends if it does, but it means that it was just overvalued. And hopefully we get there without something breaking.
Yeah, I agree. Now, yesterday you put out a number of recommendations as to what to do with what the Fed is doing. Did you want to go through some of them and some other thoughts on that?
Well, generally speaking, Mike, I think it goes along with what we've been talking about generally. You know, just to give you one example of something I recommended selling, though I annoyed a couple of people thinking that I had changed my long-term view, is that back mid-year, I told people to buy a good slug of AGQ, which is the Pro Shares Leveraged Silver ETF, not silver stock, but just silver. We were up 40% since then, not bad move for 5 or 6 months, whatever it was. And I was quite certain and have been vindicated since before the Fed meeting that the rallies and everything, including even metals, had gotten too far ahead based on this idea, which has been disabused, that the Fed is about to pivot or do whatever. They're not going to do that. And so silver sold off hard. It's down 3% plus first thing this morning. So I told people to sell that. And I told people to top up their positions on a few bearish ETFs that bet against the stock market, because I do think that we are going to start to work lower again. I think that the odds of a Santa Claus rally are pretty much between now and the end of the year done. We already had what we're going to get of that, in my opinion. So I think that, if you're looking at the next move of 10% in the stock markets, generally speaking, there's no question in my mind that 10% is going to be down, not up. So, unless something changes that we don't see in front of us right now. So I told people to, top up those positions. And we're still net long stocks because I've got a lot of individual ones, but you don't want to be a hero right now either. I mean, there's a lot of small cap stocks. There's a lot of small cap resource stocks that have just been ugly this year. But if you know they're a good story, you stick with them. And ideally, which we've done, you trade in and out of directional ETFs, sector ETFs this year. I mean, as of the end of last week, when you average out our portfolios, we were up about 7% for the year, which isn't great, but it's pretty darn good when everybody else is down 20 to 40. And that's because we don't have all of our money in a lot of the small cap stocks, a lot of the resource juniors, which I've got a fair number of, as you know, and most of them are down. But we've made up for that elsewhere. But I'll tell you, one of the things I advocated recently for people who don't like to jump around and trade, look at this symbol HDGE, folks. It's Ranger Advisor Shares ETF. Our old friend David Tice, who once upon a time made his bones by being the manager, main personality behind the old Prudent Bear Fund. He's a senior advisor to this fund, which day to day is run by two other really good guys. One a direct protege of his, another one a like-minded colleague. And this is the best and most actively managed bearish fund. If you believe that the stock market is going to work lower, if you believe that we are in the stagflation time and PE ratios are going to compress and all this stuff, there's not a better managed bearish fund that you can get in than HDGE. So take a look at that. That's been one of my recent additions also.
Wonderful. Well, we're wrapping up 2022 and 2023 is around the corner. Merry Christmas and the best of the new year to you and your family, and look forward to having you back on the show again in the new year.
And to you, the show will go on, and we'll have new challenges and new opportunities to talk about. There's never a shortage of things. Take care, Mike.
You bet, Chris. Thank you. The Prospector News Podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.